You are focused entirely on the land of John Farrow, which is the real yield. How do we get out of the conundrum that Mr. Marks just described?
Well, the conundrum is by intent. The Fed is buying assets, and by buying assets, they're forcing people to hold more deposits than they want. Those deposits earn zero. And so the response to that is to buy bonds. Negative real yields now are touched minus 1.2% last week, in the past week. That's the lowest on record, going back to the 1990s when TIPS were introduced.
Yeah.
So it's a pretty interesting environment where real yields are hitting record lows at a time that the economy is in recovery, and inflation on a year-over-year basis is at 5%. It doesn't really fit together very well.
You mentioned the word intent. I'll bring in will as well. Bill Dudley, the key thing here is the mystery over the will and intent of the good people at the FOMC in this original moment. What would you suggest is their will and intent into the end of the year?
Well, I think their will and intent is to make financial conditions very accommodative, to provide as maximum support to the economy, to get all the people that are unemployed currently because of the pandemic back to work. They've talked about making substantial further progress towards their goals of maximum sustainable employment and price stability. They basically told us they've made some progress, but they haven't quite satisfied that substantial further progress yet. And depending on what the payroll employment report is today and maybe next month, maybe they'll have satisfied that requirement, and then they'll start to begin the taper process.
Bill, demand is robust. It's really good. Big question is, will supply arrive? That's where the hope is at the Federal Reserve. Do you share that hope, that faith that supply arrives and the participation of this workforce will recover to where it was?
Well, we're going to find out a lot in the next couple of months when schools go back into session and the unemployment compensation benefits end. Right now, we have a bit of a tension between what we're seeing in terms of job openings, record job openings, and what we're seeing in terms of labor markets. It's still a big shortfall of employment relative to where we were in February 2020.
We've been talking all week, Bill, about the fact that the Fed probably is not going to materially shrink its balance sheet. This is one of the reasons why you attributed yields as being as low as they are. You said that they should be higher. It is for the Fed's participation in the market that they are as low as they are. Do you agree? Do you think that the Fed is going to keep its balance sheet either at this pace or higher for the foreseeable future, just based on where we are economically and based on where we are with respect to the low interest rate regime?
Well, they're hoping they're going to be able to gradually shrink their balance sheet, but there's three steps. First, you do the taper, then you lift short-term rates to a reasonable level, let's say 1.5% or so, and only then do you actually start to run the balance sheet off. The balance sheet is huge right now, so one, it's going to take a number of years before we even start to run off the balance sheet, and when we do it, it's going to take a long time to get it back to a normal level.
What's the consequence of having an $8 trillion Fed balance sheet for the foreseeable future or higher?
Well, I think it basically means that there will still be downward pressure on yields until the Fed Reserve ends the asset purchases and then begins the runoff of the balance sheet. And this does put downward pressure on long-term interest rates, no question.
Bill, if you were still at the Fed, what would you say to Governor Waller after his speech this week? What would you say to him? Would you reach out privately, get on the phone, send an email? What would you do, Bill?
Look, I think it's a tricky situation for the Fed in terms of getting the timing exactly right, and reasonable people can differ about when it's time to pare back the rate of asset purchases. I think the big wild card here is the Delta variant and how that's leading to a rise in coronavirus cases. The payroll employment report we're going to get in a bit is really looking in the rearview mirror. That's where we were in mid-July. Real question is where are we going to be 2 or 3 weeks from now?
Dr. Dudley, Mr. Farrow has been impolite, so I'll go even worse. Let's go to Lawrence Meyer of Washington University at St. Louis and his wonderful monograph, a short little book on Alan Greenspan. I do think seriously, Bill, that many of our listeners and viewers really don't understand the process that this chairman goes through with the good people around him, including the vice chairman from Columbia University. How is the Powell decision-making tree different from what Lawrence Meyer described as the Greenspan dominance?
Well, I think it's more of a consensus-building process. People talk about the big three, the chair of the Fed, the vice chair of the Fed, and then the vice chair of the Federal Open Market Committee, the president of the New York Fed, John Williams. Those three get together frequently and discuss what's the appropriate course of policy, what should the FOMC statement look like. So it's not just one person setting policy. It's the three people sort of driving the process forward. And then, of course, you have to bring the other members of the FOMC along with you.